Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're
creators
going mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Pangea, Schroders and Illuminate Financial organized a group of private markets participants and companies in London to discuss trends that will feature in the 2024 landscape. As part of the event, Pangea asked Alt Goes Mainstream to sit down with some of the participants for short conversations to discuss what they are working on and to hear their views on the future of private markets. I hope you enjoy.
We're going mainstream.
Our first conversation is with Spencer Lake, partner at 13 Books. Spencer, welcome to this AGM short with Schroders and Pangea. So, pleasure to have you here. You have a fascinating background in your prior career in banking, now as an investor. Would love to hear a bit about your background to start.
Good. Well, Michael, thanks for having me. So I was a banker for 27 years at Merrill, when it was still Merrill and then HSBC, and ultimately ran either cap markets globally, then the markets division globally, and then the banking division globally. So actually we span the universe of public and private, and some of our better performing businesses were in the alt space, where we did alternative asset class financing around infrastructure, real estate, just sort of static assets that mapped across lots of different verticals, and we would finance against them, et cetera. So sort of big fan of that space. And I think I moved into this digital world, if you will, investing, because when I ran markets, it was an $11 billion business, and we spent about $2 billion on technology, and we had the ultimate spaghettigram across, at the time, 80 countries, and it never really worked, but we tried hard. And when I ran banking, it was about the same size business, 10 billion versus 11, and the budget for technology was literally 150 million. And so it was all people, end to end. And so when we went through a lot of kind of stress over the course of time, which all banks do, mapping through that and understanding it was very, very hard. And so when I left in 2016, I just wanted to, go into the FinTech space completely to understand how those kinds of problems could be solved.
What did you think were some of the biggest problems to solve initially as you started investing at 13 Books?
My top 3 or 4 issues, we got stuck with a bad money laundering problem when I was at the bank, and we went through a decade of trying to solve for that. So KYC and the automation of complex entities and multiple jurisdictional entities and PEPs became a bit of a passion. So I put some money into that, and I still love that space. Lending money was a problem. Biggest asset class across banks globally, the single biggest asset class. It's an alt asset class, if you will, and it's very, very cumbersome end to end, very, very expensive to run for banks. And yet, we haven't gone down the road, and they haven't gone down the road of tokenizing it or somehow coming up with something more efficient. And the third was in the data space. I think we had, when I was there, within markets alone, probably 8,000 people who day to day, in some way, shape, or form, were reconciling data, because we had all these old systems and all these different reconciling between product and cash, balance sheet to balance sheet, entity to entity, division to division, so that we could report at the end of the day was a ginormous task. And so data quality, data simplification, data reconciliation, still, I think one of the biggest problems out there. And so I started with that kind of stuff, and then I went beyond, because that can get kind of boring, but it's fascinating.
But like you say, huge problems to solve. I mean, if you think about private markets, there's so many problems to solve when it comes to both reconciling data and reconciling people. How do you think about those two worlds in the context of private markets?
I think reconciling data across all these different asset classes so that you can have kind of one, if you will, homogeneous or dashboard view, so that you can look at real returns, because real returns, that's what we're all in it for. And even if you're selling or buying, you're still looking at the real return. that continues to be quite difficult. And getting accuracy of data within that is quite difficult. And I think across the people that are doing that, it's even more difficult because everybody's got their, peccadillos that they look for, and they've got the different kind of formulas that they're trying to solve for. And so, you see platforms that maybe can help solve for that kind of stuff, but getting, then again, the buyer to be consistent so that you can use one common platform across a bunch of people and a bunch of asset classes is quite hard. And I think regulation is going to solve for this in some way, shape, or form, which we can talk about at some point as well, because I think that banks have too many vendors in some way, shape, or form. And this new legislation called DORA for short is really going to try to address that, I think.
You bring up a really interesting point, which I think is to some extent unique in the private market space, which is there's certain businesses that will create standardization. That's probably a good thing. They may end up becoming industry utilities. So then as investors, obviously we have to think about that. How do you think about what you just said around creating unified solutions, maybe standardization? How do you think about that now as an investor, not sitting at the bank like you were as a user of a product or a vendor?
I think as an investor, you can't count on it because the horizon could be super long before you get there, I think. And at the early stage, we're a sort of late seed through B round investor. At the most important critical point of a vendor's life is how do you grow big? How do you take 5 customers and sell the same thing to 100 customers? And then you've got the model right. I think those days are becoming more and more complicated because the buying patterns at these banks are becoming more and more complicated. But I think you can't invest with the view that all of a sudden this is going to be the platform that people add to as a build and buy type of strategy. I think you have to take the view that they have to run it themselves. But what I would say is that we are, I think, at the time now when technology consolidation is going to accelerate. There's been lots of mini-me's created in lots of verticals with lots of bright young things that are coming out by lots of bright young things coming out of university. And there's no barrier. Capital has been aplenty, so you can go and create an iteration of this and an iteration of that. And when you look at the derivations of it and bring it back to the mean, it actually looks very, very similar. And the USPs are quite hard to pull out. I don't know what the right number is, but when you speak to chief revenue or chief risk officers at the big banks, and I think it would be the same thing at the asset management, maybe less, and at the insurers, maybe less, because they bought less tech over the course of time. Their single biggest risk today is resiliency. They do not understand how porous their circumference have become, where the bad guy, and it's really the cyber risk that goes along with that, and the data leakage risk that then becomes an issue. They're very concerned. So this thesis now, where if you have a bank with 5,000 vendors, you probably need 2. And so you'll see this forced consolidation. But again, as an investor, that's the worst thing to look out for because you might be at the losing end of that.
Really interesting point. And I think you have a fascinating vantage point on this because you're on the board of arguably one of the most successful FinTech and SaaS businesses, Encino. What lessons can you learn from Encino that you can apply to private markets technology companies?
It grew up as an operating system with a Live Oak bank in North Carolina. Encino is Live Oak in Spanish. And it was built on Salesforce. And I think when they first started to build it, the word got around that a operating platform was being built. And they had a handful of modules. And then before you knew it, 10 banks said, I'll take the same thing. So it was spun out, called Encino. And now it's got 1,800 banks on it. And what have they done? They've sold the same thing repeatedly as an out-of-the-box, non-customized solution that's now scaled for the very biggest banks, like a Bank of America or a Barclays, and the very smallest community bank in Connecticut or wherever. And what they did when they started, I use the term, they started with 5 modules. Now they have 25. Each of the numbers 6 through 25, they went to the existing banks and asked them, is this adjacent? Would you buy it? And they said, in a majority of cases, yes. And if they said no, they wouldn't build it. And so their growth has come organically. Net customer retention is very, very high at that company. They service the customer well by bringing all of their divisions together into the decision-making, the customer success, the sales, the product, the technology guys. And so all of a sudden, it's one one living organism that's partnered up with a bank who just has tons of adjacent problems across vanilla or alternative asset classes, from a credit, underwriting, origination, processing, analytics, blah, blah, blah. And so great lesson to learn on how to just do what you do well and only add when it makes sense for your existing customers. Don't try to, reinvent the wheel all the time, because I think you'll fail many, many times, unfortunately.
It's great advice, particularly for alts founders who have, in many cases, I think the possibility of working with strategics or corporates. I have to ask one final question, because I'm so curious. What's in a name? Why 13 books?
So my partners were working with Michael Spencer at ICAP, and their fund was called Euclid, who's the great 300 BC mathematician who wrote 13 books of elements. And when we created Element Ventures, we decided to creatively have financial technology entrepreneurs as us, and we called ourselves Element Ventures. And what you then notice, even though you're trademarked or whatever, is that there's an element insurance, there's an element, candy store, there's element capital. There's different forms of element out there, number one. And number two, what we've really noticed in the FinTech space over the last handful of years is that the adjacencies in energy, in gaming, in healthcare, are becoming ginormous. And so we spend all of our time now looking at these adjacencies, and that's just another chapter. So we thought that 13 books actually was more representation of the way FinTech is evolving. And at some point, we won't only be doing venture. I'm sure we'll have growth funds and, as the firm evolves. So 13 books, capital just felt like it was capturing the next evolution for us. So 13 books. What chapter of private markets are we in right now? I think we're still early. I'm a big fan of what you're doing, in that I think that the private markets as an asset class, just on the kind of corporate side, between corporates, it's like 5 or 6 times the public markets. And it's just a question of time before liquidity has to come in to monetize what is currently more difficult to monetize. We had the global financial crisis 15 years ago, and that was a massive injection of equity into the system, which created big upside for the alternative asset classes and the public markets, broadly speaking. And then we had COVID, unfortunately, that injected now a lot of money. The sovereigns are now, their balance sheets are really quite stressed. If you're non-emerging markets, you're quite stressed. Their currencies, as a result, become stressed. I don't envision another big flood of liquidity, nor do I expect that historical flood to come out too quickly, because that's quite difficult to do when you have also credit issues in the system or whatever. So what you can envision is that the public markets are not going to see that big buoyant upswing for a period of time here. So the private markets really now are going to be dependent upon themselves and technology solutions in order to become liquid, because otherwise I think the models change. I think the models are changing, right? Because venture, the big venture outcomes going back into the Netflix, it's an IPO, where ultimately that private investors arguably overpaying quite a bit. In hindsight, not really, because the companies had continued to grow, et cetera. You mentioned that on stage. I do think you might see a different environment here for a period of time, because you're passing from one illiquid pool to another illiquid pool. And so tokenizing those assets, creating exchanges, and I think the NASDAQs of this world are doing a wonderful job. You're going to see the LSE and others do a similar type of, I think, that has to come. So I think we're still very early on into the alt liquidity dynamic. We're going to have to write another chapter and have you come back and talk more about this. I think liquidity and returns, that's the next chapter of private markets. And we need to talk more about that in the next book that we talk about. Good. Thanks for coming on. Pleasure to be here. Thank you. Our next conversation is with Toby Bailey, Vice President EMEA at Canoe. Toby, welcome to this AGM short here at Schroders and Pangea event. Thank you for having me. Pleasure to have you. You have a fascinating background in private markets, working at some really foundational companies that I think have informed a lot of what's happening in private markets today. Yeah. So we'd love to start with your background and then how you got to Canoe.
So backgrounds, I think the most relevant background would be from iLevel, when I was the number 3 hire for iLevel in Europe, so pretty early on in our journey. Not long after spinning out from Blackstone. And that was really at the forefront of the portfolio monitoring, the start of portfolio monitoring really. Prior to that, everything had been done in Excel. So what was apparent then was, portfolio monitoring had been an afterthought. It had been, let's get the data in, let's see what we can do in Excel, let's have some rudimentary analysis here. But then iLevel came in and really streamlined both the kind of data collection and the ability to really use that data in a more meaningful way. And had some great success and grew very quickly, acquired by iPrio, then IHS Markit. And then I worked for a company called CPRES, which is more on the LP side. And the one thing that I'd noticed at both iLevel and CPRES was when speaking to an LP or a fund of funds, you could show them the best demo in the world, but the elephant in the room was always, how do we get the data in there? Because the data's always coming in PDF documents, there's no structure, there's no consistency from one fund to the next. And, historically, to solve that problem, they've been outsourcing it to offshore managed service providers, or they have teams of people in-house that's been doing that. I happened to be in a meeting with someone who mentioned Canoe, and I was like, say that again? But they mentioned Canoe, applying a technology to this space. And actually on the back of that, I found a couple of our senior leadership team on LinkedIn, and I basically wore them down over the course of the first year of COVID until they finally agreed to hire me in 2021.
Sounds like that's a pretty good signal as a salesperson, though. Sure, find someone on LinkedIn, reach out, and figure out how to work with them.
Well, I hope so, yeah. And it was I'm very lucky to have been successful because it's been a great journey since then. But again, I think what Canoe does really well is it solves a problem that was an afterthought. People they needed to get the data in, so they just threw bodies at the problem. Whereas Canoe took a systematic approach to really try and design a smart process to get that data in.
Why do you think it's taken so long to get to the point of where a solution like Canoe exists?
I mean, I suppose that people were just happy with a manual process. As long as they got the data in, LPs traditionally haven't been that demanding on data and the speed at which they get data, but that's changing. And I think maybe the drive from the LPs for more data, more faster data, has led to this opportunity for companies like Canoe to come in.
Why did you focus on the LP side rather than the GP side?
I suppose the best reason there is that there's more consistency in the type of documents that are being produced by GPs, more consistency in the type of documents, not necessarily the format of these documents. But even with that, there's the ability to benefit from economies of scale. We have a concept on the platform called shared intelligence, which means that even though investor-specific documents contain data relevant only to that investor, we can share the intelligence that we glean from those documents and apply it to other clients' instances as well. So whereas with portfolio companies, every company is going to report something completely different. There's very industry-specific things that are going to be reported that are going to vary depending on the portfolio company as well. So I think that some structure and that some consistency lent itself to being more successful with the LPs.
At what point do you have a tipping point of data that becomes useful to not only enable you to track and categorize this data, but then leverage it for insights that you can provide to both the LP and the GP community?
I mean, I think we're there now. We have 37,000 funds in our fund master, which is a pretty good portion of the entire universe. So I think we have it now. I think, and who knows what the future holds in terms of that data, but for the time being, we need to continue doing what we've been doing to make us so successful, which is improving the efficiency by which these investors are getting the documents and getting the data out of the documents. But yeah, the insights that we could get from this data, not just, we got real-time views on the cash flow data, so where money is being invested real time. But then recently we've gone into the underlying asset level data as well from these funds, from the funds that we're covering, which is going to provide, unrivaled access to what's happening in the private capital space at the portfolio company level. What's driving valuations and growth within these businesses. So that's pretty exciting.
Sounds like benchmarking maybe in the cards.
Benchmarking, but other uses like cash flow forecasting, liquidity stress testing, which is a big theme, certainly in Europe for investors. So yeah, there's lots and lots of applications of that data.
Who finds more value from that data today? Is it the LPs who are your customers, or is it the GPs when it comes to the underlying company level data?
I think there are applications for both, but potentially the GPs, because the type of data we're getting, we're not just getting the holdings level data, we're getting the operating metric data as well. So, companies, LTM revenue, EBITDA, net debt. So we can really, we're getting quarterly data as well. So people will be able to track these businesses and produce value creation analysis on these businesses. I think it will have to be anonymized, but still you could filter down to specific industries, specific geographies, and that could feed into a GP's due diligence process.
Is it the GPs who are providing the company level data, or is that also coming from the LPs?
How do you mean?
You're getting the company level data, not just the portfolio level data, but you're getting all the metrics in the company.
So it's coming from what is reported by the GPs to the LPs. Yeah. So that's the path for us at the moment.
What do you think are some of the missing pieces to the puzzle that still remain to be unsolved in post-investment phase of the market infrastructure life cycle and within private investments?
Post-investment, I think everything that is required is certainly on our radar. So we collect all documents that are produced by the funds. We don't necessarily process every single document yet for the data that's included, but with the developments in generative AI, the availability of this technology, it's not going to be long before we start implementing more advanced extraction techniques to be able to handle every single document that the funds are producing. So that would include things like LPAs, so we can track all the terms within an LPA and when they're updated. We're already doing tax documents. We're already doing the asset level data. So I think in terms of the post-investment use case, we're already quite far on the road to doing everything. Where we will always stop, or I think we will always stop, is we will then get the data, verify it, and then deliver it somewhere. So we're not in the business at the moment, certainly, of producing the analytics that the LPs or the investors want to conduct on the data. We can feed whichever platforms they're using, because we want to save all our development resources for what we do best.
What's the next transformational leap within this realm of private markets, and also maybe talk about that in the context of the next step function change for Canoe as a business as well?
So I think, on the back of this ability to go down to the asset level within documents, there's a big opportunity in the secondary space. Obviously, the secondaries, there's a lot of money in the secondary space at the moment. And an issue that they have currently is the ability to, in a timely way, analyze potential investment opportunities where they may be given access to a data room full of documents where they have a limited amount of time to be able to process those documents, get the data out, and then make an investment decision. We, in the near future, will be able to help them do that through Canoe in an automated way. So we can take all those documents in, feed the data that they need. So I think in that way, we're going to start moving away just from the middle and back office and start working with the front office teams. And I think ultimately, help provide more liquidity in the overall private markets.
You mentioned liquidity. What does liquidity look like within the context of private markets in the future?
I think it's going to be a big theme because of the retail investors that are getting involved, and the old model might not necessarily appeal to everyone. So there needs to be some liquidity to keep the demand from the retail side. The answer to that question is probably beyond me. It's too big a question to be able to answer.
That remains to be seen and will unfold. We could probably talk for much longer about all of this.
Yeah.
This was great for an AGM short, so thanks for coming on the show.
Thank you very much. Appreciate it.
Appreciate it, Toby. Our next conversation is with Rezso Szabo, General Partner at Illuminate Financial. Rezso, welcome to the AGM short here at Schroders and Pangea event.
Fantastic. Thank you for having me.
Pleasure to have you. I think you have such a fascinating perspective, having invested in capital markets, infrastructure, working with a number of capital market participants. A lot of your LPs are institutions who participate in capital markets. And then you've also done a lot in digital asset space. So would love to start by just hearing a little bit about Illuminate and what you focus on.
We are in effect 10 years into building a venture fund. So, I think that is the definition of an emerging asset manager, though it is a long journey. We raised 3 funds. It's a team of 21. We are based in New York, London, and Singapore, and that's not a coincidence, right? So it's large financial centers, and we invest in what we think is generational challenges, shifts in affecting financial services in one way, shape, or form. We are a very early stage investor compared to some of the usual guests. So think of us as a Series A late seed investor just when companies have sold to 1, 2, 3 large clients or medium-sized clients, and that's when we come in with a go-to-market perspective, right? Like, how do we help early-stage entrepreneurs solving a critical business problem for the industry? How do they go to market? Actually, knock on the large institutions' doors and help them get to the right decision makers, the right adopters. And it's a lot about bringing together the user of technology, the people with problems, with the solution, and allocating capital as kind of the third side of that table.
You mentioned generational transformation. What do you think is that generational transformation in private markets?
Maybe to take one step back on, like, I'm a macroeconomist by academic background. So I think how the world allocates capital is always to the best opportunity. It should be to the best opportunity or the steepest value chain the capital can find, and help the opportunity live up to that potential. So if I look at capital markets, fairly successful in that, right? Like, there is obviously a lot of things that we could point to that does not work. If I look at private markets, it's far less obvious that it's working well. So if we look at how the talent life cycle works, right? Like, someone comes up with an idea, wants to start a company, gets funding for it. How does that get into the world where the world allocates capital to that journey? And that's where it's what's changing there is, I think, multiple things. One is there is a lot more talent going into these earlier stage, highly risky companies to build something. And that's not a given, right? I think it's perhaps a given if you lived in San Francisco for a few decades, but it's not a given if you lived in London. It's not a given if you live in Madrid. It's very different to get an engineer who can pretty much pick and choose what they do, or get a banker who is on a high salary and get them to take all the risk for some asymmetrical upside down the line. And so I think one is that there is a supply of talent that's coming into solving some unsolved, underserved problems. I think the second thing is, and that has to be private markets, right? Like, really hard to straight off shoot into a public company and get working on something new. The second shift we are seeing is, and we talked a little bit about this on the event as well, who captures the value when that growth curve starts to really look exponential in a company journey, right? So when a company really hits its stride, and we can talk about there are so many examples, but I don't know, Stripe, Databricks in the data space, or something even like very consumer driven. Pretty much the value gets captured earlier. And you spoke about this many times on your podcast, but private companies stay private for longer. I would argue potentially forever. So in terms of the world allocating capital to this space, it's actually far more important as a problem than before, right? Like, it's just I wouldn't say existential for the asset management industry to find this way, but there is certainly a very big missed opportunity.
You're hitting on something really important, which is you're seeing a lot of asset managers get into alts. Franklin Templeton bought Lexington as an example. BlackRock just bought GIP, and they have a large alts business, but traditional asset managers know they need to move into private markets. So I think you're hitting on something important, which is many of the companies are staying private longer. On that point, given that you have such an interesting vantage point within capital markets, investing in a lot of trading in tech, having some of those firms who are core to trading and technology market infrastructure as investors or LPs in Illuminate. Do you think if private companies stay private longer, will we start to see a more liquid private markets? And if so, what does that look like in your mind?
Yeah, I mean, this is sort of the $1 billion question, right?
Only
how
1
does
billion?
Yeah, well, a trillion. Yeah, I guess $100 trillion question just to get the number right, or at least the order of magnitude. I think that frankly, the honest answer is everyone knows the destination, and no one, I think, knows the route to get there. So, like, we can paint an utopistic picture of, yes, this is how it should work. There should be a lot more liquidity. It should be readily available. There should be, valuation marks driven by that. There should be infrastructure that drives all the kind of quarterly benchmarking on the back of that. There should be public scrutiny or semi-public scrutiny on the data. The data should be standardized. The investment process should be transparent. It should be, I guess, democratizing in a way. I think what is very hard is that there is no commoditization of the asset, right? Like, these are unique assets, and one company does not look like the other one. And yes, that's true on the stock markets as well, but not the same way. Like, you can go and dig in and find some data and look back, benchmarks, and all of that is missing, right? Like, sort of almost everything is missing. So what's the road forward here? And that's, I think, where we see a route around the data, and I think that's the trivial bit, right? Like some of the data is very niche, so some of the problems are very specific to specific workflows, but getting the data right is the first step. Like, you knowing what you miss out on is I guess a start, right? That creates the demand, or at least channels the demand in. So I think that's going to be the first thing. You speak about a lot of workflows changing and platforms becoming more end-to-end and servicing some of the broken value chain or operations. We are not necessarily the best people commenting on like what happens there. I guess as venture investors, we are looking for what can create the momentum to have sustained proof points over stages of growth, and that's I think what I'm sure you're finding hard as an investor as well. But what is not trivial is how there are existing solutions, there are existing platforms solving some problems, but it's easy to imagine there would be a need for 100 times more or 1,000 times more solutions. And it is really difficult to sell to this industry, what isn't. But B2B is hard. Selling to asset managers, getting them to productize some of the things that don't exist is tough. And so asking a 10-people team or 20-people team to raise enough capital from the markets to run at this like 12 to 18-month sales cycles, to get these large buyers on board with perhaps also changing their behavior or their team or organizational structure, or perhaps even culture, right? Like, is there a risk-taking culture supporting the change or not? Who benefits from sticking their neck out? If you know that you found your change manager or leader, that's probably how I would see it. It's probably more an organizational cultural shift that will come first before the technology gets there second.
What would you say is the most exciting area of private markets right now in your mind?
The question is very hard because inherently what we believe in is it starts with a small problem that the company solves, and then they roll that forward into solving more of the value chain, or at least that's how we see companies built. We believe relatively simple things like that sound simple, like LPGP reporting, is a great problem to start with. I think the intersection of AI we find very useful for this data angle, because it directs eyeballs, it directs attention, not necessarily desperately needed immediately, but it does create a bit of a vibe, a momentum, a top-down attention. So I think that's, if I had to pick one thing, I would say that kind of end beneficial owners understanding more what they have indirectly invested in, what's the performance, how is that doing versus their public markets investments, understanding what they are perhaps missing out on by lowering the allocation. I think that's one. I think the second thing, you touched on something earlier in this event that excites us a lot, which is the kind of ultimately the rearranging how portfolio allocations work between credit, between public, between private. And I think that's going to drive enough of a momentum and shift and demand that sort of solutions kind of have to emerge to meet that challenge.
That's, I think, a great way to wrap this up. We could probably talk for much longer about all this stuff, but what you're getting at is data and post-trade. And I think those categories of the alts market infrastructure life cycle are fascinating. You've made a number of really interesting investments in this space, so congratulations on that. And it's great to have you on this AGM Short.
Thank you very much for having me.
Thanks, Rezso. Our next conversation is with Dan Kramer, CEO of Jade. Welcome to this AGM Short.
Thank you.
Here at Schroders and Pangea event. First, would love to just hear your background. You've got a fascinating background that's spanned banking world, that's spanned the startup world. You're now doing some pretty interesting stuff in AI, also related to the alts world. So would love to hear that quick story.
That's great. So I thank you very much. Thanks for having me today. I spent almost all of my career in financial services, broadly defined. First half was in the sales side, sales and trading roles at a variety of different firms. Ended up running trading businesses. Went to Deutsche Bank, ran the sec lending and prime brokerage business there. Transitioned to the buy side of the business was when I was asked to be the COO of Deutsche Asset Management. I did that. I was based in Frankfurt for that role. Took that role. Then moved on and went to JP Morgan, where I ran the fund services business, BNY Mellon, where I was the CEO of the asset servicing business. And then about 4 years ago, I heard the siren song of FinTech, was asked to run a company via VC, which was meant to be a 3-year venture. It was right before COVID. COVID hit. That company did really well through COVID. Was a trading platform, did really well through COVID, and ended up being sold to Carlyle. I managed that sale process. And then when that closed, one of the investors in that company is an investor in Jade, where I am now, and asked me if I could come do it. And I thought long and hard about it. And what excites me about being at Jade is that it solves a problem I haven't seen solved. And that's exciting.
Would love to get to that, but before, sure. Because you've had such a deep and experienced background in private markets and sec lending, prime brokerage, that you saw the hedge fund world as the hedge fund world was expanding. You mentioned your work at JP Morgan on the asset servicing side. Would love to hear some of the things that you've learned from being in and around private markets for so long.
Things that I've learned about what I've learned about being around private markets so long. So in much of my career, I've managed both what you would call manage work for traditional managers and alternative managers. What I've learned is, yes, alternative managers can be very demanding. They demand a level of service, a level of expertise, whether you're on the trading side or the administration side. But if you focus, where people have gone wrong is focusing their model on the lowest common denominator. And where I've succeeded is actually taking the demands of the higher need clients, and if you can service them well and meet and delight them, then you're certainly going to delight all your other clients. So they've always held me to a higher standard, and I've learned that don't be afraid of those higher standards. Achieve those standards, and then you'll achieve with all your other clients.
So another interesting piece of this is you've seen the evolution of private markets over time. What do you think, from what you were doing before to what you see as the gaps that need to be filled today?
It's all very similar, to be blunt. I hate to be the one who's saying, what happened before happens again, and it goes in cycles, but it's all about transparency of information. Because whenever all works well, you don't have to have full information when things are going well. But when things don't go well, when there are liquidity events or there's concern in the market or there's high growth, and in order to resolve a difficult situation, you need transparency. It's important to have it before you need it, right? So I've learned that throughout time I've lived through, a number of the major liquidity crises in both the hedge and private markets. And in all those times, the companies that survived, the managers that survived, were the ones that understood their positions well and had clients who with whom they had been fully transparent. And it's the same thing now. All the markets have become more complex. The different investments people are going in, the infrastructure investment markets, the private investment markets, very complex, very illiquid markets. It's important to know what you really have and what your position is and where you stand in the cap stack and all of that information. So
Where does Jade fit into all that?
what Jade is able to do is we use AI to make sure that the customers of the managers, so the LPs, are when they have concerns or questions about what's going on in the fund, as they send in that information, rather than have your team spend their time answering those questions, researching things, we apply AI to service the clients, answer their queries, manage that on your behalf, and allow you to focus on your investments.
So you're starting in the fund admin space within private markets for Jade. Why fund admin?
Why fund admin? It's like, what did Billy the Kid say? Because that's where the money is, but it's where the problem is, right? So it's a very manual process. A lot of the queries, as I've said earlier to you, is that the problem we solve is that humans will communicate with you however they want to communicate with you. Email, fax, phone, chat. They're going to come in and communicate you. Many of them, the managers will set up portals, or they'll say you've got to use my data standard, or the administrators will do that. But when someone has a question, they're going to send you an email, they're going to pick up the phone, they're going to send you a fax, they're going to whatever, carrier pigeon, it doesn't matter. And you have to be able to answer that query and go to them. And your LPs won't be happy if you tell them, well, we'll only answer your questions if you come to our portal. What Jade allows the managers to do is meet the clients where they are and communicate with the LPs how they want to be communicated and manage whatever whether it's a capital call, whether it's a corporate action request, whether it's a query about an investment, whatever it is, we can manage that for you using AI to understand the communication.
How does Jade actually do that in terms of managing the communication and then enabling the manager to meet the LP where and how they want to communicate?
Right. So depending on how you currently communicate with your clients, many of you have shared mailboxes where client queries come in. So the first place we start is, we call it solving the curse of the shared mailbox. So we'll go in, we'll read and understand the communications that are coming in from your clients. We'll figure out where that goes. And then we'll either integrate with your administrator directly, with your people on your team, if that's the right place to go, or with your systems on the other side to answer the questions on your behalf. And we can either answer the questions directly using generative AI, or we can have human-involved communication and go back and draft a note for you to be sending to your client, or suggest possible answers to you. If you want to be the one having that direct conversation, we can just make sure you're prepared and the answer is on your desk.
What do you think the impact of AI will be on some of these post-investment processes, like you say, in terms of efficiency, cost savings?
What we like to say is our clients can have it all, right? There's always a trade-off between efficiency, client experience, control, and employee engagement. Many of the queries that are coming in, what I say is no one goes to college for 4 years to resolve a trade query, right? So you have trouble. It's true. So you have trouble with retaining staff. All of our clients see improvement in client engagement, reductions in employee engagement, reductions in attrition. All of our clients see improvements in control. You're not going to miss a communication. You're not going to miss something that comes in. We won't. The system won't let it happen. We'll make sure that all the communication is addressed. But more importantly, we'll also make sure your clients are getting an immediate response to their query, and that we track it to make sure that they're happy with the response that they get. So your client experience gets up. But in this day and age, the CFO holds sway. We will make it more efficient. So depending on where you are in your growth curve, you can either do the same work with less resources, and those resources will be more engaged, or most likely you're growing, you can grow without having to add more resources.
What do you think is still missing from some of the technology solutions within private markets that will make some of the things that you're trying to do easier?
Really, you asked me what I've learned over time. The systems are not yet integrated, right? So it came out on the panel today, especially with the way these managers have grown and the administrators have grown, you could have one administrator with 3 or 4 different accounting platforms, three or 4 different reporting platforms, and another tax platform. You've got to communicate with all of those. So that's good for us because we can manage that we can understand and know which system to go to. It actually is, as an AI platform, makes it easier for us than a human because we can quickly learn and adapt that way.
It's fascinating. What a great way to wrap this up in terms of understanding kind of where we were, but also where we need to go. And it sounds like you're doing really interesting work in this space. So congrats.
Thank you very much.
And
I appreciate
congrats
you
on
taking the
everything
time.
you've done.
Thank you.
Awesome. Thanks, Toby.
Thank you. Bye-bye.
Our next conversation is with Tom Davies, Managing Director and President of Forge Europe. Tom, welcome to the AGM Short
Thanks for
here
having
at the Schroders and Pangea event. Pleasure to have you. Would love to start. You've been in the private market space working with individual and institutional investors now for quite some time. So we'd love to start just hearing a little bit about your background and how you've seen this space evolve in Europe.
Sure, yeah. So my career is a bit of a game of two halves, I guess is probably how you'd say it. Began my life as a lawyer a long time ago, and then cut my teeth in the startup world at Seedrs, the equity crowdfunding platform. Joined them in 2012, first employee there. And Seedrs is very much playing in that retail, ultra retail end of the spectrum. Our tagline was, you can invest in startups for as little as £10. We were very much going hard and trying to tackle that mass affluent side of it. Fast forward to today, I joined Forge in February last year, so just past my annual anniversary. Very much focusing now on the institutional side of the market, so a bit of a change of pace. I think there's some pros and cons in both of those ends of the spectrum.
What do you think that the institutional side can learn from the retail side? Because we often think about it the opposite way around. First it goes institutional and then something goes to the retail or individual channel. But what do you think that the institutional side can learn from the retail or individual investor channel?
I think that there is. I'll give you a specific example. So when we started Seedrs, one of the most innovative things we did was the SPV nominee model. Now that was something which wasn't widely known back then. We used essentially, it wasn't an SPV per deal. We had a subsidiary company that acted as the custodian. We had all of the regulatory fund management permissions to make decisions on behalf of the retail. And what it enabled us to do, particularly when dealing and supporting with these £10 investors, was essentially negotiate and enter into a shareholder agreement on behalf of those retail investors. It meant that we can provide that institutional grade level of protection for them. But also the benefit of that is we then launched the Seedrs secondary market, which then allowed beneficial to beneficial unit trading. Highly efficient, super scalable, work really well. Interestingly, what we're seeing on the institutional side is more institutions being willing to participate in SPVs and to benefit from the unit-to-unit trading, which they wouldn't have touched that 10 years ago. So that, I think, is probably the best example of an institution now kind of following what actually we designed for the retail.
So you're saying that the retail channel paved the way with the concept and structure of the SPV for institutions to feel comfortable doing that. That's fascinating. Let's go to the institutional side now, because I think what's probably on a lot of people's minds is what's going on in the secondary market, particularly in Europe. I think there's been plenty of successes in Europe from a venture and startup perspective, but also a lack of liquidity, it seems, which LPs seem to be feeling. What's the current market sentiment right now?
Yeah, I mean, I think we're at a bit of an inflection point, to be honest. I think that what we're seeing from let's use the VCs as an example. I think the word secondary was like a sort of Voldemort word that you should never speak as a VC. I'm seeing a categorically change and shift in attitude. And I think, I'm starting to actually come across VCs hiring portfolio managers as full-time roles to rebalance portfolios, actively manage these funds. That just didn't exist. Actually, a few years ago, it didn't exist. And what we're seeing is, the liquidity pressures, the need to return liquidity back to these LPs in order just to hit carry hurdles, raise the next fund. VCs are engaging in this. Now, the reason why I use VCs as an example is I think that's the hardest nut to crack. These secondary specific funds have been around for a while, but we're definitely seeing more of those. But when you start seeing VCs whose bread and butter is primary rounds, and starting to see them engaging in secondaries as well, that to me is a sign of an inflection point.
It's a fascinating point. Brings up two questions. One, do you think that going forward, the skill set of a VC will change, given what you said?
In short, yes. I think that the invest, wait, an IPO happens is going to make up a minority of that skill set. I think that the active management, which I don't think exists in most VCs, is going to be a skill gap that needs to be plugged.
Do you think that's going to create more of a trading mentality, in a sense where an early stage investor may look to exit at a certain stage to get liquidity and then be able to raise a new fund or things like that, as opposed to hold until, as we all know, private companies are staying private longer. So you're almost going to get these kind of stages, or people are still going to, people are still going to hold versus be more of an active trader to some extent. Maybe that's too strong a word, but that concept.
I think it's going to depend. I think you're going to have probably varying tactics in VCs. I think you'll get some VCs who will invest and hold. You'll get some that will be much more active in terms of trying to flip it, for a better word, in sort of a couple of years. And frankly, if we do our job right at Forge, we should be able to provide the infrastructure to allow that trading on a more regular basis to happen efficiently, quickly, and I see no downside to that. I think, though, that there are some challenges, and we're very honest about that. There's information challenges. There are, illiquidity in this asset class, which I don't think anyone's going to solve. I don't think this will ever be a highly liquid asset class. It just won't. I don't think it'll be highly automated. I think it's a bit like the fixed income market. There'll always be a person that needs to be involved in getting these spreads to a point where there can be a trade that happens. And that's okay. That doesn't mean there's not enormous amounts of inefficiencies that we can help solve. But I think from a VC perspective, I think you're going to get some that, frankly, they're going to have to, not have to. I think there's an opportunity that if there's an accretion of value ladder where someone who's in day one can make a lot of money on day 10, and someone can take it at day 10 and make a lot of money to day 20, each one has a different risk profile. And you see a lot of these institutions coming in who wouldn't have touched privates, but now when it's a Series E, 10-year-old company, massively de-risked, then there's even money to be made right at the end of that baton handing over to the IPO. And I think this is where it is a bit of a win-win. People aren't selling just because they're bad companies. They're selling because they're sitting on a return, and the next person can also sit on a return, but with a different risk profile.
How do companies feel about that?
I think that is probably one of the biggest challenges, and something that we are absolutely focusing on at Forge in Europe is bringing the company along with the journey. There are three parties to a trade. There is a buyer, seller, and there's a company. And often a lot of these kind of smaller broker houses ignore the company in that journey. For me, I think the biggest opportunity is actually founders, exec team, and employees. They can participate in this regular trading of their shares along that journey to a big IPO with the support of the VCs, because they're doing the same thing.
You bring up a great point, which is more structured liquidity solutions for companies, right? Particularly as the company grows, but oftentimes, the founders and team are the ones who are not taking liquidity while others can along the way. So I think that's a fascinating point. One final topic I want to cover is, what does the European landscape look like in terms of exits and IPOs going forward?
I mean, I think you've seen this trend, which isn't, a secret, that the companies are staying private for longer. I think IPOs, you only need to look at why people IPO'd. Traditionally in the past, it was to raise capital at a certain size. With so much capital flowing into the private company space, that need for IPO has got less. Hence, these IPOs are getting pushed out. And I think there's also a recognition among the public equity investors that a lot of the value of these stock markets are concentrated in a handful of companies at the top end of it. And there's this long tail of stuff that's just not really moving and not really making particularly interesting returns. I think what I'm most interested in is how regulation plays a part in this. Because I think one of the biggest problems we've got is, at the moment, private versus public companies is completely binary. One day you're private and the next day you're public, with very, very different obligations and requirements and costs laid onto you. I'm seeing in the US and these murmurs around potentially, for example, requiring companies of a certain size to disclose a certain amount of information. I think we're going to have a bit of a gray area from a regulation perspective, which I think is going to be an opportunity. Increase the information flow, but not to the extent of a public company, But that, I think, will greatly increase the ability to actually trade this stuff because there'll be more coherent information.
What kind of role can Forge play in that as a trusted party, intermediary, or connective tissue that's enabling that to happen?
A platform like Forge, I think, serves primarily three things. It's scale. And like any market, you need scale. Scale begets scale. There aren't going to be a lot of winners in this space because it's a very high barrier to entry. You can look at that in the public stock market. There are quite a few exchanges, but actually there are only a few that really matter. And so providing scale and liquidity that comes with the scale, that's something that we have a huge advantage of. We're been around for a long time. We've traded 13 billion, and particularly with us coming to Europe, we can leverage that liquidity. I think the second thing is data. We are sitting on a lot of proprietary data because we are end-to-end involved. We're not an aggregator. We're end-to-end involved in that trade, and we have the real data, which then leads me to my third point, which is trust. I think, like any marketplace, infrastructure behind the marketplace, you need trust. And that's what's lacking a little bit because it's a bit of the Wild West. No one really knows what information is out there. And I think having a centralized place with the scale, with the liquidity, and with most importantly the trust, that's what completes, I think, a marketplace at scale.
It's a great way to encapsulate what you're doing in a broader market and serving such a big need. So, Tom, thanks for coming on this AGM Short.
Thanks for having me. Appreciate it.
Appreciate it. Thank you. Our next conversation is with Levent Altunel, co-founder of Bunch. Levent, welcome to the AGM Short here with the Schroders event, Pangea. So, welcome. Pleasure to have you. You've been on the podcast before. Obviously, since you've been on the podcast and over the past year and a half or so, you've built and transformed your business, Bunch. We'd love to hear what your current thinking on the market is and how you've also transformed your business in that context.
Yes, of course. Thank you very much. Thanks for having me. It's an interesting one because I think we have changed as a business quite a lot while the vision and the problem we're solving has actually stayed the same. So we believe that there really has to be this unified platform, this unified infrastructure that helps fund managers end-to-end in their journey. And while we were in the beginning very much focused on the SPV side, we started a little bit venturing into the fund space. We now see that having this end-to-end solution from fundraising through onboarding, through reporting is super, super powerful. And I think one thing that we've done over the last half a year or so is that we've also started to go a bit deeper in the value creation piece. And so have also ventured into thinking about how to automate the fund admin piece.
What do you think is the biggest problem that funds need to solve that you want to solve for them?
It's also a very good question. I think depends on the type of fund you ask and the size of the fund. But what is definitely true for all of them is that they have incredibly separated data silos. So the information they have on the asset level is not interconnected. So they get different types of information from different types of portfolio companies. They don't live in one database. Same goes for the general fund information in terms of capital calls, reportings, etc. And then when you go towards the LPs, also the information that they have on the LPs is not really stored somewhere in a very efficient manner. And so this, if I would have to say, so what is true for an emerging manager, for an established manager, perhaps a private equity fund, is having that unified data layer, this data lake, is something that is a problem for all of them.
How do you get that data both from the funds, from the companies, from the LPs? Is that something that you can enable the creation of, or is that really relying on those constituents to share their data with you?
Yeah. I think we've realized that the process of actually solving specific problems and collecting the data while solving that problem works quite well. So example is we've built the fund onboarding solution, and that helped us gather a lot of information on the LPs. And this information we can then reuse once they sign into a new fund, or also when we think about building out the fund CRM piece, right? So we gather the information through solving specific problems and then storing them in our data lake in the proper way.
What does the future look like for you? As you said earlier, you started in the SPV space, providing SPV solutions both to funds, angels, and companies as well. You now have a fund admin product. what does that fund admin product look like, and how do you think about the future?
So when we think about what we want to build, we know that we want to build a place that provides more liquidity for private markets. And the problem that we see is twofold. One is the investment horizon. So the nature of private markets being illiquid leads to them also staying illiquid. And the other problem is the information piece. So really the private markets are private, right? That's the idea behind it. So data is not as accessible as in public markets. And we believe that to get there, you need a good way of collecting and gathering the data. And we see fund admin as one of the very, very beautiful ways to get in there, because you gather information on the assets, on the fund managers, on the LPs. And using that information, you will at some point be able to provide more liquidity. And so when you ask me, what do we think was the next step for Bunch? I think we have to go into financial services. And there, it's a huge problem that needs to be solved.
Financial services, what do you mean by that?
So generally speaking, when we look at financial services, there's the enabling piece where we say, okay, you need a treasury, a bank account opening. It has to be easy. It has to be simple. You have to be able to deal with it the same way that people are dealing with their neobanks. Like the banking experience has to become more, I would say, enjoyable. The second piece is then when it comes to liquidity products. And so what we're looking at is really the first product would be a capital call credit line. I think in the current market environment with the interest rates where they are, something where especially the emerging managers are struggling with a bit. However, the GP credit line and the capital commitment credit line together become a very, very attractive solution. And so this is the first product that we're looking into. We've already enabled FX on our platform, and I think there's a few other things that we have in the back of our pockets.
Is that what you think really differentiates you as you move into the fund admin space from other admins? And maybe as well talk a little bit about that market structure, particularly at the smaller end or longer tail of the fund admin space, where feels like it's a pretty fragmented market now.
So I think when we look at ourselves, right, where we are very excited about is building that front end, that distribution channel for GPs. So essentially becoming the place that GPs go to solve all their problems, whether it's an AMLO that they need, whether they need a capital call credit line, or whether it's something else. We have it in our suite, and we obviously partner with different providers in the back, and and basically have them provide the service. And this helps us really become that central interface for the fund managers. When you then look at I would say, space where we're obviously currently very strong at, which is the emerging fund managers, I would say generally fund managers at around 100 million AUM. It is a very fragmented space. There's lots of, I would say, mom and pop shops that do this fund admin product. And we believe that there is a huge opportunity to build something that is almost going to become like a monopoly.
Final question. What is most exciting to you about private markets in 2024?
That's a good one. So I think there's this one big piece of retailization that everybody will talk about, but there's another one that also everybody talks about, which is the Gen AI piece. And I think where we see the biggest value is in collecting unstructured data and making it structured. And the second piece is thinking of how to automate everything around the bookkeeping piece. And we see that the combination of OCR and Gen AI will enable us to actually solve a lot of the data collection problems and also solve a little bit the human capital problem, where we are able to scale the service providers that would previously do these things manually.
Exciting. We had to get AI into this.
Yes.
Awesome. Well, Levent, thanks for coming on this AGM short. Appreciate it.
Thanks for having me.
Our final conversation is with Jay Wilson, partner at Albion. Jay, welcome to this AGM short here with Schroders and Pangea.
Thanks for having me.
Pleasure to have you. You've had a fascinating background in capital markets and now as a VC investing in various forms of capital markets and alts-related businesses. We'd love to just start with your background of being in capital markets. What do you do and what was that like?
Yeah, so I've been involved in financial services for the best part of 20 years. I started my career in capital markets, running a small business, and as we were talking earlier, like the evolution of the alternative space in the private capital markets today just very much mirrors what was described then about the liquid securities, be they derivative securities or trading in some emerging markets. And so we started a business actually just before the financial crisis, which, as you can imagine, was a fantastic time to do something like that. And so we were trading in securities, in equity-linked securities in emerging markets and in derivatives. And we did that for the best part of 10 years. And then I've been an advisor, again, in financial services, in lots of payments, as well as capital markets. And now for the last 5 years, I've been investing in financial services and FinTech at Albion. And we're a London-based VC. We manage £1 billion of capital, and we're investing in early-stage B2B technology companies. Financial services or FinTech is the largest single vertical within that. And when we talk about FinTech investing, what we really talk about is investing in technology companies that sell to financial services institutions. And with that mandate in mind, right, that'll point you in the direction of where we tend to invest, right? So we tend to invest in capital markets, we tend to invest in automation technologies. And that's obviously led us into a space and into an interest in combination with my experience and my career history that's getting us very excited about private capital markets today.
So you saw some of those technology evolutions or market structure evolutions as well in equities, in investing in emerging markets. What would you say are some of the mirrors of some of those other market structure evolutions, equities, fixed income derivatives that you're probably exposed to as well? Thinking about that in the context of the market structure evolution that's happening in private markets or alts.
Yeah, so I mean, it's a great analogy. And if you abstract out of private capital markets or alternative assets, right, what you're really describing is illiquid securities. And we understand a lot about the market structure of illiquid securities and the evolution because we've seen that play out in lots of other asset classes before. And, just to bring back to sort of my original experience, this was a market that was niche to begin with, that was characterized by high fees, a small number of players. And over time, as more assets and capital flooded into that space, you get scale. And with scale, what you run into operating processes that fundamentally cannot be solved by just adding more people. So you've got a scale problem. And then what happens is, with scale, you get pressure on fees, and so margin goes down. And then that compounds the issue that you have with scale, which is you don't have the cost base to be able to service the revenue you have. And then you overlay regulatory scrutiny, which always happens as a function of those two other things. And so you've got this trifecta of issues that creates the need for building technology solutions. And predominantly those solutions are in their infancy, some sort of system of record, and then always automation around that. And if you look at where we are now, right, particularly exciting areas in the post-trade part of the private capital markets, right, it's all about automating that post-trade value chain.
What did it take to electronify the markets that you were previously in, and then maybe overlay that on what do you think it's going to take to electronify alts market structure?
Yeah, it's a great question, but fundamentally it's like not a switch, right? It's a transition, it's a spectrum, and it's actually very similar to the technology adoption cycle of every other industry, right? So you go from purely paper-based to managed service to product. And so you can imagine teams of people in offshore countries transcribing, whether it be performance data, whether it be reporting data, to outsourcing that completely as a managed service. And that managed service may have some technology underpinnings to do it on an automated basis. But then fundamentally, the customers of those solutions in-house just the products. And that is just a transition over time, as I said, as all these three factors begin to gain traction, as you get more scale, as there's more pressure on fees, the need to focus on that transition becomes more acute. And that is exactly where we are today, as I'm sure you've highlighted.
Yeah, I mean, you think about it, you mentioned the post-trade space. I think that's one of the most exciting pieces of private markets innovation right now. You've invested in a few companies in this space. What makes you so excited about that portion of the market structure evolution?
I think a couple of things. I think one, it's a very repeatable use case. And so, you put this investment lens to it, what you're trying to repeatable use cases that you can scale very quickly with capital. It's a very repeatable use case. Fundamentally, you're talking about building consistent data structures. And now I think we've got to a level of maturity where, we have this consistency in data structures. Number one, the adoption of, whether we call it generative AI, but advanced analytics technologies is at a point where those customers are comfortable with using it, and not just at a data science level, right? So they can deploy this to analysts, and with that they're starting to see the real value cases come out of it. And that's sort of the critical point, which is like the value case for the adoption of these technologies is very obvious. And to contrast it with the technology adoption cycle of other technologies, blockchain, for example, like we saw the commercial value proposition very quickly in these value chains.
What most excites you about the companies that you've invested in this space recently? Accelx is one.
Yeah.
Sounds like you've done more in this space as well and are very focused on it. So what problem are you excited about solving in the post-investment part of the life cycle?
If I was to abstract out of these two investments, one of the sort of common themes that runs through our entire investment portfolio is some level of data analytics. And in the case of private capital markets, right, this is not an API game yet, right? So you have to build some fundamental technology to generate the data that you wouldn't have otherwise have. And that is a moat that is fundamentally, once you get to some level of scale, very hard to replicate. So this starts to build characteristics of a great investment lens, number one. Number two, like this is low-hanging fruit in terms of commercial opportunity for these customers. They all know that they are employing perhaps not hundreds, but at least tens of people to do very basic data analysis and data transformation work. And that is just the most automatable use case today. And so, as I said earlier, the commercial value proposition is very obvious. And the area of the value chain that we're focused on is analytics and reporting analytics. For the body's problem, but also from the regulatory scrutiny problem. And so you're always looking for these different lenses.
How much is that going to be a jurisdiction-specific problem to solve, making that maybe important and interesting to solve, but also harder for a company to scale?
Yeah, that's a good question. I think to the extent, I think jurisdictionally, or so rather from a need perspective, this problem is on the board agenda of every asset management firm everywhere in the world. The specific jurisdiction and the regulatory implications of that are different, but fundamentally, all these organizations know that they need to make margin improvements through automation. As it relates then to the technology provision of that, I think there are only marginal differences geographically, and as it relates probably to language, or particularly in anything that relates to reporting structure. So if you think about what these companies are abstracting, it can be accounting level data. So to the extent there are differences in accounting standards, there's marginal changes, but I wouldn't consider geography as a barrier to scalability for these businesses. And if I look at, Accelx and others that we've invested in, they are selling globally today, certainly in North America and Europe.
What's the next missing piece in technology innovation in the alt space that's required to take alts, kind of as you saw with equities and emerging markets equities you're investing in or illiquid securities, to the next phase of development?
This is one where I'm maybe a skeptic, which is to say, I would suggest that we're not looking for a technology breakthrough here. We're looking for the deployment of existing technologies more broadly within the asset management firms. And actually, it's certainly the case that asset managers are not leaders in technology adoption. And so I would think about, we speak to innovation teams in these organizations, and their role is to promote maybe not the bleeding edge, but the cutting edge of technology. But actually what gets adopted and what gets put in production is not that. And so I actually see it as the rollout of existing technologies to more use cases across these organizations, and obviously extending to other asset classes and potentially other, whether it be document classes or reporting types. And the reason I focus on that is if you think about those as vectors for growth and vectors of opportunity, there is so much white space there, before you even need to begin to consider the adoption of a more advanced technology.
Sounds like we've only just started a conversation that could go on for much longer. I wish we had more time to dive into this. We'll have to do that next time. So, Jay, thanks for coming on this AGM Short.
Thanks so much. It was great.
I hope you enjoyed these exciting conversations about the state of private markets. Pangea, Schroders, and Illuminate, thanks for collaborating on this. It was a lot of fun. Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.